Hey, what's going on everybody? My name is Fernando and I am a real estate investor here to teach you guys about the 5 different ways to finance your out-of-state property. My wife and I, we started this journey 2 years ago in 2020, and since then we've helped others also find out-of-state properties and partner with them. So if you're looking to learn how to invest out of state, this is the channel to follow. If you get any enjoyment from this, like and subscribe, and let's get started. Okay, so the first 2 ways to finance an out-of-state rental are the easiest if you are a W-2 earner, meaning you actually have income, you can show pay stubs, maybe 2-year tax statements and all that stuff. It's a lot more paperwork that you're needed, to show income, proof of income, but you are gonna get better rates. And if you can do that, then the option number 1 as a very regular conventional loan for out-of-state rentals, it's a 15 to 20% down payment, and then the bank goes ahead, gives you the rest of the loan. Okay, that's option number 1. Option number 2 is still for W-2 earners. You can leverage your vacation home loan. This is where you can use 10% down. Super clutch when you want to reduce your down payment. Very, very helpful. And then we get into the more complex loans that allow you to scale, even if you don't have a W-2 job. So if you're like me, self-employed, you don't have guaranteed 2 years incomes, your tax returns are kind of all over the place because you don't really want to show income. Anyways, people are always telling me, oh, Fernando, how are you going to buy a house? Well, these are the options. So option number 3, this is called a DSCR loan, a debt service coverage ratio loan. What this basically means is that if your income from the property equals or is greater than the mortgage, insurance, and taxes of the property, well, then you'll get the loan.
Interesting.
That's how simple it is. They don't look at personal income, they'll look at property income. The way they do that is they'll look at market rents. If you have experience already in that area, then they'll look at your previous rent history. If you're a short-term rental, some different lenders do different things where they'll take 50% of what the short-term rental could perform at. If you're like me in midterm rentals, then they just kind of take your word for it, depending on the lender that you go to, obviously. When you show them the data. So they don't take your word for it. You have to show them the data. You have to show them that you can meet their threshold. Okay, so that's a DSCR loan. You're still gonna need 15 to 20% down on the DSCR loans. So your down payment's still a little higher. Your interest rates are gonna be a little higher by like 0.5%. Your credit score still needs to be above 680, but no proof of income, no W-2 needed. Super, super cool.
Nice.
The 4th strategy is one of the coolest strategies. It's one that we recently came across and one that we're actually using in a partnership right now, which I'm going to get into. So this is where you can leverage a current property as your down payment. So if you have an owner-occupied home with equity, or if you have another rental property with equity, there are lenders out there that will take a line of credit from those properties and use that as your down payment for your rental property. So you could theoretically get away with 0 money out of pocket for your down payment. I'm talking about liquid cash, by leveraging your other assets. It's the coolest way to leverage other assets. The other cool part about it is now you're leveraging debt from your property, which debt is not taxed. So you could use that money, put it into your property, and not have to worry about paying taxes when you go ahead and move that money around. So this is all super crazy ways to be able to buy real estate without actually having to pay taxes. All right, so that was the 4th way. Using a lender to go ahead and leverage the equity you have in a current property. So you have to have a current property, and then being able to use that as a down payment. All right, the last and 5th way on how to leverage to purchase out-of-state property. When you're partnering up with private investors, or you're partnering up with partners in your LLC, in your business, if you are doing all the work, I call that sweat equity. Like me, I'm doing all the work. My wife and I, we've spent over 2 years learning out of state, learning how to explore different markets, learning how to analyze deals. And they're just people who don't want to do the work. And so if you're watching this video, you're probably not one of those people. You're probably wanting to learn, wanting to do the work. So you have the advantage that after you do it the first time, boom, don't say you can't do it. You already know how to do it. Now you're just bringing the opportunity to other people. So that's the biggest thing. And by learning these financing methods, you get to come to them and be strategic with, okay, you have a W-2, you don't have a vacation home, boom, we can use you like this. Oh, you don't have a W-2, but you don't have any liquid cash, but you own another rental property, this is a strategy we can do for you. Oh, you don't want to show the debt on your DTI, you don't want to carry the loan, boom, DSCR loan. So a DSCR loan is also really cool because it doesn't actually show on anybody's DTI. Nobody personally has to put their name up for a DSCR loan because it's classified as a commercial loan, so it goes under an LLC. So that's why it's one of my favorite loans to be able to actually scale up. All right, these were the 5 ways to finance an out-of-state property. I hope that you guys enjoyed it. Again, please like and subscribe. It's gonna help the algorithm just go ahead and start sending this video out to a ton of different people. And if you like this, I mean, tell me in the comments what's another creative way that you figured out how to finance your out-of-state property.